Good evening, everyone, and welcome to Financial Independence Through Small Multifamily Investing. I'm your host, Lawrence Laddie, also known as Mr. International. Tonight, we have a very special guest tonight. He is the founder of a podcast. Uh, he is also the creator of the Tribe of Titans, right? The podcast is The Diary of an Apartment Investor.
Yep.
And he's also an investor.
Yes, I am.
And as a matter of fact, I just found out, tell about it. He's about to close. Right? That close, right?
That close, yeah.
That close.
Yeah.
I met Brian during the pandemic. We're in the pandemic. Brian started his Meetup, right? And it was on Fridays at 1:00, right? And Brian's really a fantastic guy, wonderful individual, family man, and also thank you for your service, retired Lieutenant Colonel from the U.S. Marine Corps.
Yep.
So
Awesome.
Before we begin, though, Brian, we go around the screen and ask everybody, please introduce yourself. A quick 30-second introduction of who you are, where you're from, and what you're looking for, what you're doing. So we're going to start to my left, your right. Sharon, come on, Thomas. Sharon Thomas.
Sorry. I am a real estate broker in the state of New Jersey and Pennsylvania, and also an investor and a builder. We build homes.
Awesome.
Thanks for coming, Sharon. Arthur, get Arthur.
Hi there.
We're having technical malfunction here today.
So yeah, I'm here with my partner, Ellis. So I'm also a private money lender.
Okay, welcome.
So we're here to network and just meet more investors across the nation.
Awesome.
Welcome. And also next we have Mark Gilbert. Mark, please introduce yourself, please. Mark?
Yeah. Can you hear me okay?
We hear you now.
Perfect. Yeah. Mark Gilbert. I'm in the DMV on the Maryland side, an investor, an agent, and doing some work with self-directed IRAs.
Awesome.
Thank you for coming. Welcome.
Yep. Looking for 30 to 60 unit multi-unit properties. So
Okay.
Great. All right. Welcome. Once
Awesome.
again, Lawrence Light, host of Financial Independence. I'm located in the Bronx, New York, and I hosted Meetup since 2020. And I'm looking for properties in the Piedmont Triad area, also looking for properties Hampton Roads, Virginia area too. So without further ado, we have Mr. Brian Briscoe. Thank you, Brian, for coming on. Appreciate it.
Thank you, Lawrence. Very much appreciate it. Thanks for being patient. We are closing on a property tomorrow morning. We were supposed to close on it today. We had a couple of there's always last minute hitches. But just to give you an idea of my last 24 hours, it was about this time yesterday, I thought everything was, perfect. And then we got an email from the lender saying your insurance policy isn't sufficient. We're not going to approve your insurance, and so, that was after most people have closed for business, so we were able to get our broker on the phone just because, we've got his cell phone number, and talked to him last night, and he's like, okay, I got it. We'll make sure we're at work early in the morning to start working it. Anyway, about an hour ago, we ended up getting the green light from the lender over the insurance. So we made some small changes, and we convinced them to make some small changes to what they would accept. And then we realized that through all the hustle and bustle that out of the gigantic stack of documents that I signed and sent in, I missed one, right? So I was at the UPS store yesterday getting documents overnighted, and I was in the UPS store today again getting out documents overnighted. And unfortunately, I'm going to have to go back tomorrow to get documents overnighted one more time. So, what can Brown do for you? Well, I'm looking at what I can do for Brown, and that's, put a lot of extra money in their back pockets for not keeping my for missing some of the documents, right? So anyway, little bit, I guess since we're talking about this, I'll just tell you a little bit about the property that we're buying. And along with that, I'll tell you my philosophy on a lot of things. Okay. So first of all, I'll hit philosophy, and then I'll tell you about the buying. I mean, my history, I think Lawrence told you a lot. I was active duty Marine Corps for 20 years. I was born and raised in the Salt Lake City area, and I am a big Utah fan. I have also lived in the DMV area like Mark. I've been on the Virginia side and I've been on the Maryland side. But once at Marine Corps Base Quantico and once at the Pentagon, where I was just living on the Maryland side. But 20 years in the Marine Corps, I was one of those guys that after September 11th, on September 12th, I was knocking on a recruiter's door saying, sign me up, right? And so I retired 2 years ago this month, which happened to be 20 years and a month after September 11th. So that's kind of the story there. Started picking up single family properties while I was active duty. The goal was every time they moved me, which was 10 times in 20 years. The goal was to try to buy a property each time. Didn't quite make it every time, but bought enough properties that I could, it was kind of like a proof of concept. I could see the value of real estate. I could see the property values going up over time. I could see the cash flow coming in, and I wanted more. All right. So when I had about 3 years left in my military career, that's when I got transferred to the Pentagon, and they tell you how long your tour length should be when you transfer. They said, we're going to send you to the Pentagon for 3 years. I took my shoes off so I could count all the way up to 20. And I said, I'm at 17 years right now. 3 years takes me to retirement. I'm like, this is my last move. All right. So that's when I really started doubling down on investing, and that's when I really started pushing into multifamily. Prior to that, I only had single family homes, but the push after that was, let's get into multifamily real estate, and got into a coaching program that helped tremendously. And now I'm paying it forward through my own coaching program as well. That's the Tribe of Titans that Lawrence mentioned up front. But in my last 3 years active duty, working on basically nights, weekends, and days off, I was able to get 700 units in my portfolio, and I wish I owned 100% of all those 700. But what I did is I would syndicate properties, which means we would go find the property, get it under contract, basically do all the work on the properties, and go find people who wanted to invest money with us. Okay. So on any given property, I'd have, $25, $50, $100,000, depending on which property it was, invested of my own money. Quite honestly, there were several properties where I had $0 invested. But over the course of about 3 years, got up to 600, 700 apartments, units. And that's when I retired. Since I retired, I've added another 700 units to the portfolio. And I founded a new company based out of Salt Lake City. So that's my background, and my focus right now is Salt Lake City. So going into kind of my philosophy on apartments, I think right now is a really good time to buy. Okay. A lot of people are going to think I'm crazy, but I think it's a really good time to buy. All right. Why do I think that? Well, the property we're buying right now would have been sold at $300,000 a door. It's downtown Salt Lake. The owner could have gotten 13 or 14 million for the property a year and a half, 2 years ago. They're selling it to us for 10. Okay. So when you look at where prices are now compared to 2 years ago, arguably the market hit its high at the end of 21, maybe early 22. But if you look at where we are right now from the market high, a lot of metros have dropped by 20 to 30%. Okay, so it's like, whatever it is you're looking for, it's like you go into the real estate store and everything's marked 20% off, clearance sale, everything must go type stuff. So that's how I'm looking at the market right now. Is we're going to buy things at a discount from where they were 2 years ago. Okay, now interest rates kind of suck right now, I get that, but that's partly why we're able to get properties at lower prices. All right. A lot of people will point to cap rates and interest rates. When you look at the two, if you don't know what a cap rate is, the cap rate helps you determine what the property price is. Okay, you take the income off of the property. It's a math equation. You take the income off the property, you apply a cap rate, and that gives you the value. Okay, so commercial real estate values are based off of the income stream, and the cap rate is just a multiplier or a number that you use to determine what each dollar of income is worth in terms of property value. Okay, so a couple of years ago, just give you perspective. So give you a little bit more perspective. The lower the cap rate is, the higher the property price, okay, or the higher the value each dollar of income is. Okay, so low cap rates equal higher prices. Okay, what is mostly true, or what's been true for the last 20 or so years, that there's been on average a 2 to 3% difference between cap rates and interest rates. Okay, that's the average. Okay, it didn't hold true in the 80s and 90s. It really didn't. That they were actually the opposite direction in the 80s and 90s because interest rates were so high. But last 20 or so years, and what most people look at, they think there should be a 2 to 3 point spread between interest rates and cap rates. All right, and right now in many markets, it's a negative spread. Okay, so a lot of people are looking at negative spread and saying, oh my gosh, it's a terrible time to buy right now. And I look at that and I say, is it really? All right, because there's other factors involved. Once again, the cap rate tells you how much each dollar of income is worth right now. Okay, but there's another big thing that I think a lot of people aren't really accounting for. It's a little bit more nuanced than you take your income, you divide it by a cap rate, and that gives you your value. Okay, it's much more nuanced than that. We also have this big thing called inflation. All right, now, if you believe the CPI numbers, if you believe what the Fed chairman is telling us, inflation is going back down. Okay, the reality is, if you take the CPI, the Consumer Price Index, which is the metric that we use to determine what inflation is. When I say we, it's the metric the government uses. Okay, there's a lot of different things that go into that number. The biggest part of the inflation number that has come down is energy prices. Okay, your gas, your petroleum, any of your petroleum-based products, natural gas. Okay, that's the big part of the CPI that has come down in the last 6 to 8 months. Okay, and you look at and you start scratching your head and thinking, why did all of that go down? Well, the answer is the federal government, the executive branch, they control, the Department of Energy controls the Strategic Petroleum Reserve. Okay, they have essentially been, and what the Strategic Petroleum Reserve is, it was started in the early 80s because of the fuel crisis. Okay, and so it's meant to be kind of like a buffer for U.S. energy. So if OPEC stops pumping, all right, or if there's an international fuel crisis, we have these reserves to be able to provide to the U.S. citizens. All right, what's the government been doing with the Strategic Petroleum Reserve? They've opened up the floodgates. Okay, they call it the SPI, but the SPI is at its lowest point since they started filling up the reserves. And all the reserves are, it's somewhere in Texas along the Gulf Coast. You just have, a gigantic facility that just has a bunch of these little towers or whatever that are full of oil, right? So they have been pushing oil into our economy to bring energy prices down. And so when you look at the inflation numbers, why are the inflation numbers down? It's not because they fixed inflation. The inflation numbers are down because they've artificially played with it by pumping oil into our economy to increase the supply and bring energy prices down. Okay. So what I would conjecture is that inflation is still going to be around. Okay. Next data point I want to use for this is look at the federal deficit. Okay. The federal deficit in the last 3 months has gone up almost $2 trillion. Okay. That's not stimulus. Okay. That's just regular government spending. Okay. The government on average brings in 3 to 4 trillion with a T in money via taxes. Okay. Somewhere between 3 and 4 trillion. Okay. This year they're on track to spend $6 trillion. Okay. What does that mean? It means the government is printing about $2 to $3 trillion, which incidentally was about the size of the stimulus package that we got right after COVID. Okay. So on an annual basis, we are still getting trillions of dollars printed and pumped into the economy right now. Okay. What does that tell me? Well, that tells me that inflation is going to stick. Okay. That tells me that, yeah, we might have this little momentary decrease in inflation because energy prices have gone down, but they kept energy prices artificially low throughout most of the summer by, rating the SPI. And now that we're after Labor Day, energy prices naturally go down because fewer people are driving, there's less vacations and stuff like that. So what do I think is going to happen? I think we're going to have higher than average inflation. Okay. Now, what does that mean for real estate investing? We talked about cap rates versus interest rates. This is where, people who are using just the two variables in your income and your cap rate, might be missing something. All right. Because if you can expect the value of your properties to go up quickly, AKA what happens during an inflationary environment, if we have 5% inflation in the next year, it's not going to be seen immediately, but if we have 5% inflation, eventually that's going to affect the property prices. Okay. Eventually rents are going to go up by 5%, and property values are going to go up by 5%. Right? That's just what's going to happen. So if we have more persistent inflation, you buy now at a low purchase price. Yeah, you're going to finance it. But 2 to 3 years from now, if we're seeing 5 to 10% inflation, now the amount of money you're paying to finance it is a lot less 3 years from now than it is right now. Okay, because you're using inflated dollars. So when you account for inflation, now all of a sudden, the cap rates being lower than interest rates don't matter quite as much. Okay. Usually people would make money off of the spread between cap rates and interest rates. You're buying at this cap rate, but you're financing at this interest rate. Okay. And so there's money on that spread to be made. Okay. Now people aren't making money on that spread because that spread's disappeared. Where the money's going to be made is on that inflation, owning a hard asset that is very likely to increase in value over time. Okay. My opinion, some people share it, some people don't. What I would say is do your independent research. And if you agree, now's a great time to buy real estate. If you disagree, well, now still might be a great time to buy real estate because, it's discounted 20% from its peak, right? So there's lots of reasons in my mind to buy real estate right now. Okay. Now, hold times. Okay. That's the next thing I want to talk about is, what is my favorite hold time? All right. I'm going to borrow a quote from Warren Buffett. Okay. What did he say about his favorite hold time on a good investment? forever is his answer. Okay. He put that in an annual, letter to his investors at Berkshire Hathaway. My favorite hold time for a good investment is forever. Okay. Now let's look at his track record. Does he honestly hold companies forever? No, he doesn't. Okay. The reality is he buys something because he thinks it's a good deal and he thinks it's a good company, but over time things change. Okay. So you look at his track record. I mean, I think he buys with the intent of holding these companies for a long term, but he reevaluates every couple of years. And his track record on average is he's holding companies for 3 to 4 years. Okay. So his favorite hold time is forever, but the reality is he's reevaluating. He's looking at each company individually and constantly reassessing, is it better for us to buy, sell, hold, or whatever? Okay. So when that comes to real estate, my favorite hold time is forever. All right. But, I'm not just going to blindly hold forever and ignore what's going on in the marketplace. What I like, if you're familiar with the single family space, there's this thing called BRRRR. Okay. It's the buy, renovate, rent, refinance, and repeat. Okay. I don't remember the order of the R's, but it's a B and a bunch of R's. All right. So that's essentially what we're doing, is buying, renovating, refinancing, renting, repeating. So you're buying a property, fixing it up, putting a new tenant in or putting tenants in place. That's really what I like to do with apartments, because of the flexibility it gives you. Okay. Now I'm gonna contrast that or compare that with what a lot of syndicators have been doing for the last several years, and incidentally, me included. Okay, I'm definitely included in this group, but I got started in multifamily in 2018. Okay, from 2018 to roughly 2021, 2022, you almost couldn't lose money. All right, unless you're Ethan Gow and you're lending money to people who don't do a good job, buying properties. Just teasing, Ethan, but you almost couldn't lose money on a property because the prices were going up so fast. And what most people were doing was buying a property, putting on a really flimsy value add plan, changing the veneers, and selling it 2 years later, pushing out 40% annualized returns and saying, look at me, I'm king of the world, right? And oh, by the way, I did that too. All right. But I think we've seen in the last year or so the downside to that. Okay. When you have a short-term business plan, what happens in the market is a lot more important than if you have a long-term business plan. All right. And let me give you an example. All right. In 2008, okay, who sitting in 2008 would have been happy to buy things at the peak of the market in 2007? Okay. I'm guessing nobody here. Okay. In 2008, if you would have bought something in 2007, you'd be kicking yourself. You'd be like, oh man, that was the stupidest thing. Guess who bought his first investment property in August of 2007? All right. And I was kicking myself because a couple months later, the market crashed. A year or two later, it bottomed out and I was underwater on that deal. Now, the good news is I had tenants in and the tenants were paying the mortgage. Okay. So I didn't have to come out of pocket on that property. All right. I bought that house for $190,000. Okay. That house right now is worth $600,000. Okay. How many of you right now would gladly buy something at 2007 prices? I would buy everything I could get my hands on at 2007 prices. Everything I could get my hands on at 2007 prices. Now, of course, I would have had to wait, 15 or 18 years. How long has it been since 2007? 16 years to be able to make the amount of money, to make a lot of money on it. But, the point is, the longer term your outlook, the easier it is, or the less risky, that's a better word, the less risk you put in making money. All right. And I'm making assumptions. I'm going to make an assumption that, the real estate is going to turn around and eventually start going up again. Okay, that's the assumption that I'm making here, because it typically has over the past, right? So when does that short-term 2-year hold not work? Right before property prices go down. Okay, so if you would have bought a house in 2007 with a 2-year hold period with 2-year note, or maybe you're doing it from a private money lender who wants his money back in 12 to 18 months. All right, the numbers crash, prices go down, and somebody's going to lose money. Okay, so why I lean towards the model that I have right now is we're looking at about a 5-year period between purchase and the refinance. Okay, so we're not trying to compress things. If the market economics work out where you can earlier, absolutely. We'll do a refinance as early as we can and try to get the investors all of their money back. Okay, but we're not banking on 2 to 3 year refinance. Okay, can we refinance in 5 years and probably exceed expectations? Yes, absolutely, we probably can. Right? Absolutely, we probably can. A definitive maybe is basically what I said. So so the idea is we're planning on holding our properties for 10 to 20 years. We're going to buy them, we're going to finance them, and in the next 5 years, we're going to try to refinance. Now, with the market right now, I've already told you, I believe there's going to be more inflation than the government lets on right now. Okay. Now, even if that's not the case, okay, let's say there's just regular inflation, the Fed's winning, Kruger's right. Kruger's his name. Who was that economist that said the war on inflation's over? I don't remember his name right now. Krugman. Let's say Krugman's right and the war on inflation is over. What's going to happen is if rates come down, prices are going to come back up. Okay, that's going to happen. Okay, it's going to be cheaper to finance, so people are going to be like, game back on, and let's start buying more properties, and prices are going to come back up. All right, what happens if rates don't come down? Okay, what happens if rates stay exactly where they are right now? Well, it's going to take a year or two for prices to adjust, and then guess what's going to happen? They're going to start going up again. Okay, they're going to start going up again. So with a 5-year window, now there's obviously risks to this, but I think with a 5-year window, we're giving the market enough time to correct itself right now. All right, but we're also baking in a little bit of flexibility. And the way we bake in the flexibility is we try to negotiate prepayment terms with the lender. Okay, make sure that we can get out of our loan early if we want to. Now, it does cost a little bit more upfront to be able to get a better prepayment schedule. And most commercial real estate loans come with a prepayment penalty. All right, most of the fixed rate ones come with a prepayment penalty. All right, so if you get out early, you owe the lender a certain amount of money. Okay, so what we're trying to do is maintain quite a bit of flexibility in what we do, so that if rates come back down into the 4s or 3s, I'd be happy with 5s right now, to be honest with you. But if rates came back down to the 4s or even the 3s, we can refinance out when the market tells us it's a good time to refinance. Okay, and the way we're structuring our investment is when we refinance out, we're pushing the money back to the investors. We're essentially paying them their principal back, and then we're keeping them in the deal. All right, and I think now there are some pros and cons to this, but I think it gives you a little bit of the best of both worlds. All right, if you're doing the 2 to 3 year hold, you get your money back quickly. Right, there's a higher risk of loss, but you get your money back quickly, and you can keep that velocity of money up that everybody talks about. Okay, you can start, okay, I just got this big windfall. Now I'm going to start investing into multiple things and keep things moving, keep things growing fast. All right, with the refinance, you can still do that. Okay, not quite to the same extent as if you sold. All right, so you still have some of the features of these short-term holds, but over time, when you look at the people who've made millions with real estate, I mean, there are exceptions to this, but most of them have held the real estate for long periods of time. Okay, most of them are longer term investors where they're investing for longer durations, and they have the ability to watch those values go up over time, right? I mean, if going back to 2007, all right, I bought one house at 190, I think. So ballpark 190,000. All right, it was in Salt Lake City. But if I would have bought 10 of those instead of one and waited till now, those are all worth 600,000 right now. Okay. Quick math in public, that's $4 million. All right. $4 million I would have earned just from the appreciation. The power of real estate over time is, I think, what really builds wealth and what builds your cash flow streams as well. So anyway, my philosophy right now is, let's try to do something that generates wealth over a long period of time, right? That generates passive income streams over a long period of time, and isn't just the one-sided, let's hurry up and try to double you up on your money with a fairly decent risk of loss. All right. So that's kind of where I'm sitting right now. I do think we're going to have high inflation. I do think, interest rates are going to continue to go up for at least the next, I'd say 4 to 6 months. I mean, 10-year treasury just hit 5%, and, it was, 1 point something, 2 years ago, and 4 point something, 2 weeks ago. But I think rates are going to continue to go up a little bit. I think prices are going to continue to go down. But I'm still in the buying mode. I'm still raising capital, still buying properties. And we wired a good $3 million to close on a property today that we'll end up closing on tomorrow. So anyway, any questions?
Absolutely, brother.
Yes.
And pleasure, man. This is very informative, man. You are knowledgeable, and thank you for your time.
Thank
What
you.
are your off-market acquisition strategies?
So I don't do a whole lot off market. We like brokers, right? And the reason I like brokers is because brokers spend all day making calls. That's
Right.
all they do.
Right.
Right. They pick up the phone, they call an owner, they call an owner, they call an owner, they call an owner. So the best thing that I do to get off market properties is build relationships with brokers.
I'm glad that I'm on the right track. I'm talking with agents in
Yeah.
San Antonio and other areas. I figure they know where everything is. They get hit with this information first. So pay a premium, make sure they get fed, and they'll feed you. Yeah, that's
now if I can take that one step further, right now, I mean, I didn't get into the whole story, but I co-founded a company in 2018, 2019. I was with them for 3 years. I left and I started my own company. Okay. So when I was with this company, we were able to tackle deals that were, 200 units plus, because we had that engine going. Okay. I left to start my own. And so now my purchasing ability has dropped significantly, but we're working on, building back up to where I was with the company when I left. Right. So we have talked with a couple of the brokers. There's a couple of hustlers in Salt Lake City, and I mean that in a good way. All right. Look at my wall right there. I love hustle. Okay. Hustle, the most important word ever, right? But there's a couple of brokers that really want to hustle. And what we've talked with these brokers about is, what is our criteria? Okay. We have geographic criteria. Okay. There's certain areas we want to be in. We have criteria on purchase price, which purchase price translates to unit count. Okay. So we're coming into these brokers. I mean, I don't have CoStar access. They're printing us up a CoStar list of all the apartments that are in the greater Salt Lake area. Okay. And what we're doing is taking that list and we're essentially highlighting everything that meets our criteria. Okay. Location, asset class, vintage, and all of that stuff. And something else that we're doing is we're looking at things that have been owned for 10 or more years. Okay. Those owners are going to be more likely to sell. If it's been under the same ownership for 30 years, great, because it's probably a dude in his 70s. And it's probably a dude in his 70s where all of his kids are saying, Dad, you need to sell that thing. Right. So So what we are doing is we've arranged with this brokerage, call all these owners, we will pay you a commission. Okay, when we close. All right. So that's for me the best way to find off market deals. I don't have to put a lot of upfront money into doing it. But we have a broker who normally does that, and the broker can represent us in the transaction. In commercial multifamily, there's usually one broker. There's not a buyer's agent and a seller's agent, but that's going to give us a little bit more leverage with the broker to say, we're going to guarantee you're getting a commission, because the broker's cold calling sellers. Some of the sellers might not want to pay the broker's commission. So we've just told the broker up front, we will pay you a commission, and we've got two different rates that we pay him. Okay. If the seller is going to pay his normal commission, he gets something from the seller, and then we pay him a smaller number after that. If the seller doesn't want to pay him a commission, we pay his full commission. Right. So that's one thing that we're going to start ramping up early next year, is getting that broker to very specifically target properties that we want to buy. And quite honestly, if you have really good relationships with brokers, they're going to be doing that for you anyway. In this case, we're just sending them stuff. So, I mean, we've got another broker, just taking that one more step, and then I'll go for more questions. We had another broker that called me yesterday, and I don't know how many times he used this phrase, but he said, "Hey, Brian, I got this deal. You're the first person I called." Okay. Realistically, am I the first person he called? No, he's probably used that same line 8 times, but that's the other thing we're looking for, is we're making sure the brokers know what we're going to buy, what's inside our buy box. And
that was my question next, was what is your buy box, or what are you actually looking for?
My buy box right now, I'm hyper focused on the greater Salt Lake City area.
Gotcha.
Right. It's an area I know the economy is doing extremely well. The population's growing. Got a lot of fuel in the real estate market because of the Californians that are moving in. Everybody blames the Californians, but we got people moving in from everywhere. It is
blame us, man. It's not my fault.
Yeah, exactly. I mean, I've got a California area code on my cell phone, so I occasionally get confused with one of those damn Californians that everyone keeps talking about. But yeah, I mean, so number one, it's got to be in the Salt Lake City metro area. Number two, what can I afford to buy? And that depends on how much I can raise. Okay, right now, we struggled a little bit to hit 5 million for this last deal. So we're still raising money on the deal that we're closing tomorrow. So when I look at my buy box, it depends on how much money I can raise. I think we can raise 3 to 5 million. And so with where rates are right now, where debt is right now, we're looking at $5 to $10 million transactions right now. Okay. So
Gotcha.
Put that into unit count in Salt Lake City. C class is low 200s a door. A class is about 300 a door. Brand new stuff. If it's a brand new A class, we're looking, mid 3s. So looking at unit count, that puts us ballpark 30 to 60.
Gotcha. That's awesome. Now, do you use, I notice you are focusing on right now on multifamily, and I've seen this in multifamily as well, but do you do any short-term rental at all in your multifamily? Not at all.
No, not really. There's certain areas where it works, certain areas where it doesn't. Yeah, that's something I just like to be straight-laced, make it a little easier. I do know a lot of people that do.
Right. I ran an Airbnb last year, and I arbitraged a house in Phoenix. So I ran it for a year. Great experience. I'd rather do it on my own property though.
I mean,
someone else's mortgage.
Yeah, if you can do the arbitrage like that, I mean, you're making a little bit of money without a lot of risk, but you just got to be able to repeat it.
Right.
Whatever you do, you got to make it repeatable.
Gotcha. Yeah, absolutely. It wasn't enough profit, not enough for the year's worth of work that we did, but great experience, and knowing that I can do that, repeat it in my own properties in a future time.
Yep. I actually listened to a podcast. Airbnb started that way, where they were living off of arbitrage, renting apartments from somebody and renting them out for a higher rate, and that's what got Airbnb its start. Right.
Renting out rooms.
Yeah.
No, that's awesome. So do you have any other areas that you focus on Salt Lake City now? Were there any other areas that you bought in any other cities?
Yeah, the first company I was in, Carolinas and Georgia. So at one point, I think I had 9 properties in Carolina, in South Carolina, 2 in Georgia. We've since sold most of the South Carolina properties. So I think I still own 1. Yeah, 1. I do own 1 in South Carolina still. It's in Columbia, and we still have the 2 in Georgia. So I mean that's when I was with the other company. I've partnered with a bunch of people on one-off deals. So we closed in August on 1 in Charlotte. I really like the Carolinas. My wife's from Columbia, South Carolina, so
Gotcha.
we ended up going there quite a bit anyway. I've got a couple of deals in Houston. If I ever needed to check up on them, I'd call Ethan and he'd probably tell me, I ain't doing that.
Fine,
But
I do almost anything for you.
yeah. But 2 deals, 3. I got 3 in Houston right now. So, and then 1 portfolio, like a 63 unit portfolio that we bought from the same seller in Akron, Ohio, and another small property in Denver, Colorado. So most of those are just, partnerships of opportunity where people that I've met and networked with have said, hey, I've got this deal. Do you want to partner with us on it? I look at the deal, I say, what do you want from me? What do you need from me? And
Right.
if we can work something out, I partnered. So, in a couple of cases, I've brought investors to deal. In a couple of cases, I've signed on the dotted line. So yeah, I mean, that's where I've done things. But looking at my focus for acquisitions at Salt Lake City, doesn't mean that I won't partner with somebody else on a deal outside of Salt Lake City, but I'm hyper focused on Salt Lake.
Are you using any VAs or are you doing most of this yourself?
I do have a VA. She's not helping. She's helping more on the social media side than the direct real estate. I've also hired 2 people. So, the company's Streamline Capital Group. I've got an acquisitions director and I've got an investor relations director that are both on salary right now.
That's dope. I appreciate it, man. I'm all out. I'm gonna save the floor for somebody else.
All right. Cool. Who else has questions?
Brian, you talked about, networking. You talked about, changing, you left one company, went to another company.
Yeah.
How important is it to build relationships in a what's the word I'm looking for, in a partnership? And what do you look for? What are the criteria you look for to build partnerships?
Yeah, I think networking, I mean, if I had stopped networking when you created this first partnership, I would have had no options, when I decided to leave. And quite frankly, I may have chosen to stay, but I have the podcast. The podcast is a great networking tool. Basically, I email somebody and say, hey, let's spend an hour together and record a podcast. And they're like, yeah, sure, I'll come spend an hour with you. Right. So the podcast helps networking. Lawrence mentioned that I've got a Friday networking group that I've been running for 3.5 years now. But when I left that company, being able to start over again was so much easier than I imagined. I mean, there were many people that I could reach out to and just say, and so most of these deals that I talked about, like the 3 in Houston, the 1 in Akron, the 1 in Charlotte, the 1 in Denver, these were all deals that I was able to get into because of my network. Right. So it was before I started the new company and got the new company up and running. And I think as of tomorrow, when we close on this property, I can say it's officially up and running. Right. But, in the interim, in that dead space between leaving one company and starting the next one, my network was able to keep me invested in deals, so I was able to get into deals in Houston. I was able to get into deals in Charlotte. I was able to get into deals in these other places. And so, getting different type of experience. And I mean, without that network, like I said, the starting over would have been difficult. And I'm too stubborn. I don't think I'm employable anymore. I'm too stubborn to go out and get a job. I would have, made it work. But it has been very nice to have a lot of people that I knew I could pick up the phone and call in the case of emergency.
Thank you. Thank you very much. Harita, anybody has a question? Sharon?
Guys, I do got one more. If anybody else doesn't have one, I'll hold back and give you guys a chance.
I'm game.
So, what does that partnership look like, and how many people are involved in a deal like that?
Yeah,
it could be many or multiple, I guess. But when you raise that, how does that?
Ideally as few as possible. I mean, I would
Right.
love to be to the point, and I'm not yet. I'd love to be to the point where, if I want to buy that $20 million apartment, we can handle it internally, right? Because I walk out with a much larger percentage. The real answer is as many as it takes,
Gotcha.
So, in the one that we closed, my weak point is raising capital right now. And it's just because I haven't focused on it. I think I do a fair job at raising capital. And if I focused on it, I'd do a much better job. But, when you start looking at, how we put this deal together, we needed to raise 5 million. To date, we've raised around 4. We did take a small gap loan on it. I think Ethan was involved in that one. But anyway, we did take a small gap loan on it to help us make sure we were closed. But when you look at who's involved, it's like, okay, I got to raise 5 million. I think I can raise, 1 to 2 million. And we started looking around and looking for people that could help us with like $500,000 chunks, and so it's like, hey, can you raise 500 to $1 million? Yeah, I can probably raise 500. Okay, cool. And so that's where we just reach out to people in our network and say, hey, can you raise money? How much do you think you can raise? How much are you going to commit to? And so, I mean, in this case, I think we have 6 different people who are raising money with us on this apartment complex. Each person's going to get a certain percentage of ownership for, whatever they do. Most of them are contributing in several different ways. It's not just a single, that's all they're doing. But so in this case, I think we have 7 different entities involved. And looking back at it, I wish I would have had 8 because we're closing tomorrow, and I think we still have to raise 1.3, 1.4 million, something like that. So we raised high 3s. We need to get to 5, but had enough to close.
At this point, you still need to raise more, but you're still going to close tomorrow.
Yeah.
Gotcha.
And it's, I mean, when you look at everything that's involved, I mean, we've been able to assemble the purchase price. Okay, so we have the purchase price. We're going to give that to the seller. I did say we did take a loan from somebody to be able to get there. So looking at the numbers, we needed 4.4 total to close. As of this morning, I think we're at 3.5, 3.6. Okay, so there's about 800,000, 900,000 delta. We did take a short-term gap loan from someone for 1.2 million to make sure that we were going to be able to close. Turns out that we probably could have taken 800,000 and still close because, once all the dust settles, we still have 400,000 in our bank account. But, the next steps, we're going to keep on raising until we're fully funded. So for what we're doing right now is, I mean, the first dollars that we raise from here on out is going to repay that short-term gap loan. And then after that, we have to make sure we have enough money for our renovations. We're not doing a lot of renovations on this property. We've got about $120,000 worth of renovations that we want to do. And then most people who do what I do have an acquisition fee built in, that's how we pay ourselves. And so when we keep on raising, we're going to continue to raise until we have that $120,000 or so in the renovation bucket, and then another $300,000 to pay ourselves for all the work that we did. So,
Gotcha.
Yeah, that's about where we're at right now. And I don't have the numbers right in front of me, but I think we're roughly
that was perfect.
3.5 million raised, and we got to get to 5.
That's cool, man. No, that's awesome. That was a great explanation on how
Yeah.
all that works. That's
Yeah.
just somewhere I haven't been yet, brother.
Yeah, no worries, no worries. First time I did it, I was, trying to spreadsheet everything, and it was like balancing a checkbook. It's just like, okay, where's this, where's that, where's the other, this line, and you got 7 different sets of numbers, and it's a big
Right.
reconciliation project.
Right. How do you I'm pretty sure
Mhm.
there's a way of, I know apartment buildings don't have an ARV like that. It's all based upon the rental values, the cap rate of the apartment value. So when you want to buy a property and you want to add value, or you see a value add, where is that, and where do you look to be able to add value to a property that you prospect?
So there's several ways to get at value on multifamily properties. Okay, the cap rate's only one. All right, you can still get an ARV on properties just like you do on single family. Okay, so if you're doing a renovation, the appraisers are going to come in, and I mean, I did buy a book on appraisals, and it's right over there that just off screen. But there's like 8 different methods of determining what a property price is. Okay, the cap rate one is called the income capitalization approach, but there is also the market comp, the market comparable approach. You can do a market comparable valuation on a multifamily property just like you can on a single family property. And there's a lot of cases where that actually makes more sense. So for example, if you have a vacant building, okay, it makes more sense to look at the comps, to say what this is worth. I've actually bought a building with a negative cash flow. And if you look at the cap rate, take a negative cash flow, divide it by a cap rate, the seller should pay you
To take the property.
Okay, that ain't gonna happen, right? So there's lots of ways to do it. I mean, we actually look at a couple of different ways every time. One thing we do is we do look at the comparables. Okay, so all right, we have, this one is unrenovated, and we try to draw a small circle around it on the map and try to find properties that are similar class, similar vintage, that have been renovated. All right. Now, if you're in a dense area, dense urban area, you're going to have a lot of data, and you're going to be able to look at the other properties and pull some sales comps and saying, hey, right now, unrenovated properties are going for $220 a door. Renovated properties are going for $250 a door. All right. And that way you can use that to come up with a rough ARV. Okay. Say, hey, if I put $15,000 into this, I'm going to go from 220 to 250. The spread there is 15,000 a unit times 40 units. I just made a lot of money. I just made 600 grand with that, right? So I might be missing a zero, right? But I probably am missing a zero. But when you can look at that ARV, but you also are going to look at the rents. You're also going to look at the income capitalization approach. So you're going to be doing the same thing with rents. It's like, okay, right now this property is getting $1,400 in rents. The property 2 doors down or across the street, or half a mile down in the same neighborhood, they're renovated and they're making $1,700. Okay, so you can go in there and look at, now it's a timing issue as well. It's going to take us 2 years to do the full renovation.
Right.
And we're gradually bringing things from 100, I don't remember the numbers I said, 1,400 to rents to 1,700 rents. And then you can look at the new income that you're going to have, apply the cap rate, and get the new value as well. And so a lot of what we're doing is guessing at what the future is going to look like, guessing on, okay, I think prices are going to be, pricing is going to be strong for the next 2 years. But like I said, we're using more of a 5-year hold period, or 5 years till we refinance, and then a 10-year hold period. So I think there's a little less guesswork when you're looking out that far, because it's more likely.
Absolutely.
Yeah, more likely the numbers are going to be higher. But that's typically how we do it. And we come up with numbers we're comfortable with, like how much do we think rents are going to increase every year? How much do we think property values are going to increase every year? And so we come up with numbers we're comfortable with and we think we can sell to investors. And, so far we haven't had a lot of pushback on that.
No, that's awesome, man. Yeah, definitely. Just use conservative numbers that can garner a guaranteed. Somebody understand that that's what's actually going to be. No, that makes sense. Everything you're saying, it makes total sense, man. I appreciate you, brother.
Yeah, man.
Does anybody have any other questions? Okay.
Awesome.
Well, Brian, I want to say thank you very much for coming on today. I've been working to get you on here.
Yeah, and I've been doing everything I can unintentionally to give you the Heisman install, but
Listen, I know.
got really busy the last couple of weeks, so my apologies on that one.
Well, listen, I just appreciate you coming on Financial Independence through small multifamily investing.
Yeah.
Once again, thank everybody coming on today, attending this meeting.
You're waiting for me to come. That's what's up, Brian. Appreciate you, brother.
Yeah, that's it. You nailed it.
A
Yeah.
Californian, right?
Yeah. Yeah. Lawrence, I appreciate you. I mean, Mr. International, you've been stalwart and steady, and love to see what you've been doing, man.
Thank you, Brian. Thank you very much.